Autovista Group webinar. Today, we're going to be uncovering the road ahead for residual values. We're going to take an in-depth look at value retention trends, what lies ahead for the rest of this year, and what we can expect heading into 2026. I'm Tom Hooker, Autovista 24 journalist, and I'll be your moderator for today. I'd like to invite the panel to introduce themselves. Javier, could you start us off? Let us know a little bit about yourself. And while you're at it, let's jump right in with one of today's most pivotal questions. What do you think will be the biggest residual value surprise in 2026?
Good morning, Tom. I'm Javier Salgado, Director of Valuations and Forecast Experts, and today I will focus on the impact of market trends, specifically in fleets. I think the surprising my part of the webinar will be the fact that market trends affect fleets, of course, but they do not translate exactly in the same way as maybe you can expect.
Thanks, Javier, and I'll go to you next, Anna, if I can. What do you think will be the biggest residual value shock next year?
Hi, Tom and everybody. I'm Anna Lange, Product Director of Valuation Applications. And so I'll be talking a little bit about how the economy has changed, and I'm looking forward to hear of Robert and Javier what the residual value impact of that will be.
Thanks, Anna. And of course, last but by no means least, Robert, same question goes to you.
Good morning, everybody. My name is Robert. I'm Regional Head of Valuations for the DACH and CEE region. And I'm looking forward today to discuss the different trends we see for young used vehicles versus typical off-lease vehicles with 3, 4, or 5 years of age.
Thanks very much, everyone. Those are some valuable insights already. So what can you expect from today's webinar? First, we're going to be providing a view on the economic environment and how this impacts the used car market. Then we'll analyze the residual value trends shaping 2025 and the outlook for 2026. After that, we'll have a look at how these trends have a real-world impact on businesses with regard to fleet residual values. And finally, we'll be ending with our Q&A. You can already submit questions and we'll try to get through as many as we can at the end of our webinar. If, however, for whatever reason, we don't cover your question, don't worry, because we'll be reaching out via email after the webinar. Okay, Anna, why don't you start us off then with a view on the economic environment? What has changed since our last webinar?
Thanks, Tom. So similar to last webinar, I did bring some economic KPIs. So as you can see on the top left of the chart, the inflation rates. And you might remember if you've watched the last webinar, that was a bit more in the middle of the year. It did look like inflation rates in the EU countries were coming down. So we went down from 2.7, 2.8 around the year turn to 2.2 in the middle of the year. And it did look like inflation rates would be stabilizing on like the 2% mark. But since then, a little bit surprisingly, inflation rates went slightly up again. So we're sort of at a level of 2.4 now, which means that there's still sort of inflation pressure on the economy and things aren't sort of as stabilizing as we were thinking in the middle of the year. And the other index that I brought with me is the consumer price index, which is the chart at the bottom and also the map to the right. So the consumer price index is an index that indicates how much households need to spend for a standard basket of goods. So basically sort of the spending costs of a household. And in our last webinar in the middle of the year, we were already seeing the consumer price index at an all-time high in April and May, meaning that households needed to spend more than ever before for the same goods. And what we can see in the bottom chart is that since then it's ever been rising. So the pressure on households and the spending capacities are shrinking still. So we're still sort of in a tense situation. And if you look at the map to the right, we can see that broken down by country. So you can see that we got rise in consumer price indexes across the board, specifically in the Eastern European countries. And so that is partly still due to geopolitical tensions and sort of the general economic climate. So what we see economy-wise is still a tense situation that isn't as stable as we were thinking middle of the year, and spending issues basically.
And how does this rising uncertainty and tension translate into the automotive industry? What impacts are we seeing there?
Yeah, I mean, so a tense economic situation will affect all businesses, not just automotive, but obviously automotive is also impacted. So this is practically a bit the same as I said last time. So we got stagnating economies, which means that we have affordability issues in households, but also reduced investment with businesses. So it's not just private consumers that are having less money to spend, but also businesses that need to be more considerate about where to invest their money. So this all leads to a bit more of stagnation, really, and that affects automotive as well as all businesses. But if we look at automotive specifically, we're still having the tariff negotiations, so this has still not fully resolved. There are negotiations on de-escalation currently ongoing. So the EU has proposed to the US to settle the tariffs in a way that the EU would not put any tariffs in effect, for in exchange the US lowering the tariffs from 25 to 15%. But this is still in progress, so this is not a done deal yet, which means that there's investment delays and supply delays because everybody's waiting for this to sort of happen and is holding back decisions. So another bit of stagnation here that is not exactly helpful for economic recovery. And as I said last time as well, for the automotive industry, we're in a phase of a lot of challenges, technological challenges. So we got this massive EV push that is putting pressure on manufacturers to become more profitable and have like a good technological product to offer. And while we're still having that sort of technological maturation of the EVs, what is becoming more of a topic now is affordable EVs, because the market seems to be more saturated now, and manufacturers still need to get EVs pushed into the market, which means they need to become more affordable in order to increase the uptake in the mass market. So that means, well, manufacturers can hope for an increased uptake of EVs due to more affordable EVs. There's still profitability issues, so the supply chain needs to be profitable, and that needs to be sort of in a pacey and timely way. And there's a lot of competitive pressure because everybody's obviously trying to achieve the same. So yes, still a tense situation also for the automotive industry.
And I want to come back to the points that you made on affordability issues and the consumer price index. Have we also seen similar changes reflected in used car pricing?
Yeah, interestingly, so I did bring with me again the used car price index. So the used car price index is a weekly index that is showing the price changes on a weekly basis for vehicles that are sort of leaving used car portals. So we see in directly the used car portal price changes with a constant basket. So that means that any basket effect or composition in the market are taken out of this. So the average vehicle, how does the price change on a weekly basis when it's sold? And so interestingly, so I brought the similar chart with me last time. So this is indexed in January. So January 2025 is sort of the index of 100. And we can see on the left side, as we did see last time already, we had like a relatively steep decrease post-COVID. So we still had like the post-COVID normalization phase. And then if you look at the first half of 2025, so the right of the dotted line, it did look like we were on the recovery and things would be stabilizing and normalizing and sort of become more of a stable horizontal curve or line. But as we can see, like in the second half of 2025, there's still a bit of a decline. Decline is less steep than it was last year, but still it isn't as promising as it did look like in the first half of the year. And I mean, Robert and Javier will elaborate on why that is. Obviously, households are more cautious with their spending decisions, which means that there's potentially less demand in the markets, which will also contribute to prices still being on a slower but stable decline.
Thanks very much. And yeah, as you said, Robert and Javier are going to be touching on those points in a bit more detail later on. So I think that brings us on very nicely to our next section. Before we do that though, just a quick reminder that you can continue submitting your questions to our Q&A section, which will be coming at the end of the webinar. And I can already see that we're getting some fantastic questions already being sent in. So now that we have a better understanding of the external factors influencing the used car market, let's now take a look at residual values. Robert, maybe you can give us a quick overview of what trends you've observed so far this year.
Yes, so residual values in most of Europe's major used car markets still show a decreasing trend, but at a slower pace, as Anne already mentioned. On this chart, we can see an example for 36-month-old used cars for the big five countries and Austria and Switzerland. And looking at the whole timeline from January 24 until today, the trend is similar in most markets, so it's decreasing and with some more stabilization in the first half of this year, but again with more decrease in the second half of this year. There are some exceptions. So if you look on the black line, which is Germany, we can observe a slight increase since January. But this is after some corrections later in 24. Also, the yellow line, Spain, shows a bit of a more recent stabilization during the last 3 months. But to summarize, the overall picture remains the same. Compared to the levels of 24, RVs are still under those levels. And of course, below the years 22 and 23, when RVs were greatly inflated. So overall, we can still observe a continuous market normalization from our point of view after the COVID and supply crisis.
So clearly residual values are still falling then. I wonder, could other market indicators give us an even clearer picture of how used cars are performing?
Yes, when we look at specific leading market indicators, this can give us a good indication of where the market is moving. So in this case, we can see two leading market indicators. On the top of the chart, we see the stock days development by fuel type. Stock days are a good indicator for market saturation and how different fuel types react to the current market supply and demand. And in the first half of 25, we have seen for all fuel types, stock days going down, so increasing pace in turnover. But now in the second half of 25, there is more days that are needed to sell a vehicle. In this case, we see an example from Germany for 3 to 4 year old used cars that are advertised on the portals. So stock days is one indicator. The other indicator is the number of price changes, which we can see on the bottom half of the chart. This also indicates desirability of vehicles. And of course, if a dealer needs to manage the price more often, usually it means the price is going down. So he has to decrease the price in order to sell the vehicle. So if more price management is needed to create the turnover, it also indicates pressure on RVs. And also for price change count, we can see in the second half of 25 a slight increase for all fuel types in this age bracket. So this gives us another, let's say, indication of where the market is moving and that we can expect some more pressure on vehicles in this age group.
Okay, Robert, I think we've looked enough now at market indicators and residual value trends. It's time for the big question. What does the outlook look like for 2026?
So the trends and indicators that we have discussed so far, of course, they translate into our market outlook for 26. On the left-hand side, you can see the current level of residual values in Europe's major used car markets. So the pressure we have described for 25 and the current RV level for 36-month-old vehicles. In the middle of the slide, we see our market outlook. And as you can see, for all countries mentioned on this slide, the market outlook for 26 is still negative. We expect some more adjustments, but the adjustments will be at a slower pace. So for 36-month-old vehicles, our outlook suggests that RVs will be lower in December 26 than in December 25 by approximately 1 to 1.5% in most markets. Here we're talking about percent, not about percentage points of RVs, just to keep this in mind. In Italy, we expect some more corrections. But generally speaking, we can expect more pressure next year. That's why the market outlook is still slightly negative. Age group of 36 months and older will be particularly affected by this trend. And this is already reflected in our outlook and in our forecasts.
And you mentioned there at the end about younger and older models. I wanted to ask, are we seeing residual values across different age groups perform the same or differently compared to previous years?
No, there are really notable differences. So here is an example that we have prepared that showcases the whole development. This is the RV development on the example from Germany. On the horizontal axis, we have the different age points of used car vehicles, so 12-month-old cars, 24-month-old cars, etc. On the vertical axis, we see the level of RV in percentage points. And if we start with January 2020, we have seen like a typical pattern how RVs on average develop for a younger used vehicle to a 5-year-old vehicle, as we can see here indicated by this blue line. And this level was more or less stable, so there were not a lot of surprises from one year to the other. Then we had the COVID and supply crisis, and what we experienced in our markets. You can see it here now indicated by the green line. In November 22, RVs were highly inflated. So the whole levels, regardless of the age of the vehicle, were almost like parallel on a higher level for 12 months as well as for 60-month-old used cars. So this was due to the lack of supply on the markets due to the crisis. But now we have seen corrections in the last years. And the purple line now shows the situation today. So for 12-month-old used cars, we are almost at the same level like in 2020. So the correction has taken place already. We are near pre-pandemic levels. But if you look further to the right, for 36 and 48 and also 60-month-old vehicles, the gap has not closed yet. So the line, the pattern is really flat, meaning that RVs of 36-month-old cars and 24-month-old cars are quite close to each other in percentage points. So there is now more room for correction for those older age brackets for 36 and 48 and also 60-month-old vehicles. And we expect this pressure to be put on in the next years for this age bracket.
And this is a very interesting trend, but of course, this is just one market we're looking at here. So have you noticed this same phenomenon occurring across different European countries as well?
Yes, this is a typical pattern. We can observe this pattern in many European countries. So here is another example to show the development, this time from Spain. And even if maybe the timeline and the level is not exactly the same what we have seen from the German market, there is a slightly different behavior on this market, but the basic trend is the same. So we can expect more corrections for slightly older used vehicles. As I said before, 36 months and older will be the ones that are most impacted.
So why is there this disparity in residual values then? Are new car registrations affecting this?
Yes, of course. So supply is one of the main drivers of this trend. If we look into the new car registrations, but also in the used car transactions, we can see following picture. Here's an example from Germany, again with used car transactions. So used car transactions also have reacted in terms of volume to the crisis by plummeting, but in 22. In the years 20 and 21, used car transactions were still quite stable, whereas new car registrations have already experienced the decline that we all know. But now, slowly since 23, new car registrations are recovering at a slow pace, but still they are recovering in 23 and 24. Also this year we can expect more or less stable or slightly recovering volumes, and this will be also visible on the used car markets. So we can expect more volumes, more supply on used car markets for especially this age bracket of 3 to 4 years in the coming 2 years, and more supply on a market with demand that is quite, depressed at the moment, as Anne has explained before, will lead to pressure on RVs again.
And now that we've broken things down by vehicle age, I think it's a fitting time that we look into powertrains. Robert, maybe you could give us some insights into which powertrains you've seen perform strongly, which powertrains you've seen struggle, and whether there's been any surprises as well.
There's one interesting trend that we observe in most markets, and I think that's worth mentioning today, because we've talked about BEVs in the past quite in detail, and BEVs are still struggling. So RVs of BEVs are still under pressure, especially for older BEVs, but also for young BEVs if you compare them to ICE models, but also if you compare them to PHEVs. So PHEVs are performing significantly better. And basically there are two patterns. On the left side, we can see the trend for Germany, which is really similar to what we can observe in Austria and Switzerland, where only recently young plug-in hybrids have developed positively, and the gap to BEVs has widened. In other markets, on the right-hand side, you can see the example from France, but this is also really similar in other European markets. There already has been a gap between plug-in hybrids and BEVs, and PHEVs are almost at the same level like ICE vehicles. And this again can be explained by the supply differences on the used car markets. Currently, there are significantly smaller volumes of plug-in hybrids available, and they can be absorbed better by the current demand on used markets than the supply of BEVs, which has a hard time to find buyers on used car markets at the moment, and that's why RVs for BEVs are more under pressure than for other powertrains.
Thanks very much, Robert. Those are some really valuable insights there. We're going to be sticking with the topic of residual values in our next section, but instead we're going to be taking a deep dive into residual value impacts on fleets. Before we do that though, just a quick final reminder to submit your questions to our Q&A section at the end of our webinar. Okay, so Javier, Robert mentioned that 36-month-old vehicles could lose more value next year than younger ones. So let's say I have a fleet and a lot of my vehicles have 36-month contracts. Should I be expecting a big drop?
No, not necessarily. Most of the market changes Robert described are already included in our forecast values. Ideally, reforecast should stay quite stable. That would show that our assumptions were accurate when we first forecasted the value of the vehicle. Remember that most leases in Europe last about 3.5 years, so the first forecast is done long before the car reaches the used car market. So then, when conditions change, for example, demand or stock levels, we update our forecasts to include these new elements. To see the real impact, we calculate the forecast for every vehicle at its contract end date every time we repeat the reforecast to see also and compare the differences. here, for example, we have two fleets, one in Spain and one in Germany. Both are about 10,000 vehicles each, and we have repeat the reforecast of each of the all of them since December 2024 to September 25. As you can see, the average level differ, but both remain quite stable, which is good because it means that our assumptions in general were okay. In the past year, for example, in Spain, this specific fleet, fell by around 0.5, while the fleet in Germany remained stable. So that means that most market movements were already built in our earliest forecasts.
And quickly, could you give us an explanation on what reforecast is?
Okay, a reforecast is simply an updated forecast of a vehicle's value while it's already in use. So we do this for every single vehicle in the fleet, and for those, for example, just registered, but also those that are close to be returned. In short, a reforecast is the updated end of contract value for all vehicles that are still alive in your fleet. Just touching on this, the main difference between the trends that we have been mentioning before and the reforecast is that in the reforecast, we always value the same vehicle. We bought a vehicle 2 years ago, we calculated the forecast, and we then started the lease of this vehicle. This vehicle will last, it's already 2 years old, and maybe will last in our fleet another year before it will return. We are reforecasting, we are repeating the forecast of this vehicle every time we repeat the reforecast, while the trends that we have been talking about are comparing two similar vehicles, not the same vehicle a long time, but two similar vehicles registered in different moments. So they are the same vehicle, same vehicle, same configuration, same age and mileage, but registered in different moments. That's the reason why the impact in fleets is different than the trends that you see that has been explained by Anne and Robert.
Well, thanks for that explanation, Javier. I mean, as you explained earlier, and as we can see here on this graph, both of these markets look quite similar. They're remaining relatively stable. So does that mean all fleets in Europe are going to be following this same trend?
No, not at all, because every fleet is unique. We have different models, different registration dates, mileage, and brands. For example, we have lease companies which are focused on certain brands because they are captives, or we have companies which have more spread of battery electric vehicles. So even in the same country, results vary depending on powertrain or brand perception or whatever. For example, we have repeated the example now with 5 fleets in Spain. All are artificial, so it means that all the vehicles that are in December 24 are the same vehicles in September 25, meaning that we are tracking exactly the variation of our estimation, and we can see that some of these brands stay flat while others drop about 0.5 points. So it shows that each fleet needs its own reforecast to understand the true effect of the market trends in the fleet.
It's all interesting stuff. I mean, of course, in these fleets, you're going to be having a wide range, almost a unique recipe, if you will, of different powertrains. I know Robert mentioned earlier that FEV values or plug-in hybrids have struck a bit of a surprise this year. So have you seen the same thing occurring in these fleets?
Once more, not exactly, because looking, for example, in another example that we have prepared, we can see that in this case, this example is in Spain as well, and PHEVs have evolved similarly to petrols and diesel cars. When you have seen different behavior in the chat shown by Robert, and this is because our estimations were already including most of this variation that happened. While, for example, HEVs and battery electric vehicles have dropped a bit more, and LPGs are slightly up. Okay, we know that LPG is very small in Spain, so we have taken just a small sample. But yeah, they are behaving a little bit better than expected when we did our forecast time ago. Robert has explained before that HEVs has maintained the residuals at the highest level, but in this case, you see, it's not exactly the same. They are dropping a little bit more. So even when market data is the same, the impact depends on when you are reforecasting and what's in your fleet. What are the vehicles that you have in your fleet?
So, as you say, it's certainly not a catch-all scenario. Would you say that reforecasting can actually help you stay on top of these differences?
Yes. If you have a fleet, this is the only way. Reforecasting is essential because it's the only way to really see the risk and opportunities that you have in your fleet. We have another example. In this case, you can see that, for example, the RVs for Chinese brands are behaving better than we expected. They are dropping as all the electric vehicles, but they are dropping less. So then it's the reason why our assumptions before were a little bit more pessimistic, and they are behaving a little bit better now. So this is the kind of things you can see only when you do a reforecast. So by reviewing your reforecast regularly, for example, every quarter, you can adjust your provisions if current values are lower than expected. It's mandatory to have these provisions, accounting provisions. You can spot vehicles performing better than planned and update your assumptions. For example, these Chinese vehicles, if you have them in your fleet, reduce exposure when values are falling, and even identify commercial opportunities. For example, in this the case of these Chinese cars, you can offer maybe 3 or 6 months before the due date a replacement to your customer, and then you are the only one offering in this moment because the contract is not finished. So you can get an advantage of this. So as a summary, reforecast is not just a technical or accounting exercise. It's the smart strategic tool to help manage risk and find new opportunities.
Well, thanks very much for that, Javier. I think there's loads of useful information there for fleets and reforecasting. I think that brings us on nicely to our Q&A section. We've had some fantastic questions sent in, but please do keep posting them into the question box. If for whatever reason we can't get to your question today, don't stress, because we'll be reaching out to you by email after the webinar. So the first one I have here, I think I'll send your way, Robert, and maybe Javier, you can add some additional information at the end. Do you expect the residual values of older vehicles to go back to pre-pandemic levels completely?
That's a good question. My answer would be no, not completely. Why? Because the markets are currently finding a new balance between supply and demand. And further market conditions have also changed. So list prices have increased significantly in the last years, also influencing the patterns of RVs. Also, the portfolio on offer is now different. It has changed. We have way more BEVs on offer, etc. So even with the current negative trend that we have explained during this webinar, I do not expect to go back to pre-pandemic levels completely.
I would add here that the graph you have shown is in percentage. The first thing, as you mentioned, the vehicles are not the same, and the price lists of the same vehicles are not the same either, because the prices have rocketed in the last 5 years, meaning that the values in euros will never come back to pre-pandemic levels. This is clear. Second one is that now what we see is that the curve is too flat because there is no supply, not enough supply in 36 to 60 old months vehicles. This is the only way that you can have a 24 and a 36 old average car so close, because there is no enough supply. As long as we will get more supply in 36, they will not find customers at that price and they will drop. So that's the effect that we will see in the following, I would say, 3 years. It doesn't mean that the level will be exactly the same, but for sure, the curve, once everything will be stabilized, will be parallel to the one we had, pretty similar to the one we had in January 20.
Well, thanks very much, both. Anna, I'd like to be able to bring you in on to the next question if I can. It's a little bit of a tricky one, but we'll give it a go. What do you think the major challenges will be in 2026 for the automotive industry?
Yeah, Tom, so I think it's going to be a bit of a continuation of the same. So we've seen that the economy is still sort of on a bit of a downward slope, even though it's sort of slowing down, but we definitely have affordability issues in consumers. While at the same time, and as Javier and Robert have also elaborated, especially EVs need to be pushed into the market to hit emission targets as well. I mean, despite the EU loosening the emission regulations so that the emission targets don't need to be met on an annual basis. In a total of all the transition period, the emission targets still need to be met, and that needs to be taken into consideration. So that's a further push for electric vehicles into the market. And well, as mentioned earlier, is all about affordability. So there's a high competitive pressure. We also have the Chinese brands entering more successfully than anticipated into the European market. They are more affordable. And it's also a software topic. So not only getting a technological BEV that's got good range and a good battery and everything, but also the software component will become more of a topic again. So it's all about getting a competitive and competitively priced vehicle timely into the market in a tense market condition. So I think it's a bit around that general sort of trend will just continue.
And I'd like to follow up on that one, actually. You mentioned there about the EU emissions regulations and the fact that they've been loosened over the next couple of years. How is this going to impact the 2026 outlook?
I mean, it's just becoming a bit of a ramp up problem. So the emission targets that haven't been met this year, those will need to be compensated for in the next year and the year after. So basically, the fewer EVs you sell this year, the more you need to sell next year, which just will lead to more volume push and more price competition. So I think that just puts additional pressure on the EV bid, and I mean that will impact residual values. Maybe Robert can comment on that as well.
Yes, I would confirm what Anne has said. Just because there is now a bit more of a time for the transition, and the regulations are not strict year on year, but there is like 3 years time to meet the CO2 targets. It will still mean increasing EV volumes on used car markets in the coming years. So we can again expect some pressure from the supply side. The interesting bit will be the demand side. So if on the demand on the used car markets, there will be sufficient demand for BEVs at the point in time in the future, which we don't know exactly yet. So now we have a situation where there are too many BEVs on the used car markets for the demand that we see today. So the supply side will not ease. So we will have more supply coming into the used markets. But the interesting bit will be the demand side, how this will develop in the next years.
Thanks both. Very interesting stuff. And yeah, will be exciting to see what happens next year. Javier, I've got a question here I think you'll be able to help me with. How do I compose my fleet to capitalize on residual value developments, and can reforecasting help with this?
Yes, of course. By reforecasting regularly, you can see how the value of each vehicle in your fleet evolves over time. This shows you which brands, model, powertrains, or body types are holding their values in a better way. And then with this information, you can, for example, prioritize vehicles that show stronger value retention for having more of these vehicles in your fleet. So for new contracts, you can reduce your exposure to models or segments that are showing a declining trend. So okay, they are declining. I will reduce the number of new contracts with this kind of powertrains, for example, or just the fleet mix toward vehicles that are proving more stable, to be more stable and also profitable. In other words, reforecasting turns make market changes into insights that you can apply to your fleet. So instead of reacting to general trends, because general trends is not exactly translating in your fleet in the same way, you can make data-based decisions when you do the reforecast to optimize both your risk and the return you have with them.
Great, thanks Javier. And I think we've just about got time for one more question. I'll let you handle this one, Robert. Is the gap for different age groups now compared to before the pandemic for different fuel types similar or different?
So yeah, in most markets, there are similar trends for diesel and petrol cars, and also to some extent for full hybrids. So these age group differences that we have shown, yes, they are similar for ICE vehicles. But if we look into more detail into plug-in hybrids and BEVs, the patterns can be quite different, really depending on the local markets and the local market dynamics and specifics. We must not forget that these powertrains have had significant improvements in technology in the last years, and that also the model portfolio is quite different today than some years ago. So if you, for example, think of a 3-year-old BEV today, it's a completely different vehicle than a 3-year-old BEV in 2019. And this can also be seen, of course, in RV patterns. So to summarize, the different gap for the age groups is comparable for ICE vehicles and full hybrids, but there are some local differences for plug-in hybrids and BEVs depending on the state of the local market.
Great, thanks for that, Robert, and thanks to all of our panelists for answering those questions in that Q&A section. Unfortunately, that is all the time we have today, but we hope that you've gained some very valuable insights. For a recording of this webinar, head over to Autovista 24. And while you're there, don't forget to check out our next webinar, Global New Car Market Outlook 2026. If any of the products you've seen today have interested you, then please go to autovista.com/explore. A big thanks goes to the panel for joining me today and providing some fantastic insights. And of course, an even bigger thanks goes to our brilliant audience for submitting so many excellent questions and for attending. We hope to see you in our next webinar, but goodbye for now.